Gap strategy in investing. How smart investors use market gaps to build wealth. Imagine a quality company has fallen 10% down, not because the company has become bad, it is because the market has overreacted. This opportunity is called gap. Today, you will learn gap strategy, how successful investors use market gaps to invest smarter, avoid emotional decision, and build long-term wealth. What is a gap? Gap happens when a stock opens higher or lower than the previous day's closing. For example, if previous day's closing was 1000 rupees and today it opened at 930 rupees, there is a gap down of 7%. Another example, if the previous day's closing was 1000 rupees and today it opened 1080 rupees, there is a gap up of 80 rupees, that is 8%. How I have used gap strategy in HDFC Bank to buy. Today is 23rd July 2026. I bought the shares yesterday, that is 22nd July 2026. Actually, the buying price should have been today, but I had bought yesterday. So this is a chart of HDFC Bank. This is the chart of an HDFC Bank. On 11th June, there was a closing price of 745 and the next day open was much higher, as you can see here. Then it kept on moving up. Then again there was another gap which was here and it kept on moving till 830 and 840 rupees. Now by this time I already had money for the month of July, but I did not want to enter at that point because I had already marked this as my point. So I was waiting for this gap to get filled. I did not buy anything. I do not do SIP. I buy when I find an opportunity every month. If I do not find an opportunity, I do not buy. But systematically I invest, but not on a fixed date. So I had already identified this gap. Okay, it had left one gap and then another second gap here, and then it had moved to 840 rupees. I was waiting for this moment. The result came of HDFC Bank and it was not as per the expectation, and then it started going down, gap down, again another gap down, another gap down yesterday. This was yesterday's and this is today's candle. Yesterday at 555 price, I bought the shares of HDFC Bank, but my actual buying price was this price, 745, which it has achieved today. This is how I use gap strategy to buy. I do not sell, I buy a shares and I keep it forever. Why do gaps happen? First, quarterly results. When a company reports an earning which is higher or lower than the expected profit, then there will be a gap up or gap down. For example, the expectation of profit was 500 crores and the company's surprisingly reported 800 crores of profit. The next day there will be gap up opening. If the expectations were of 1000 crores and the company reported 800 crores, then there will be gap down the next day. Budget announcement. Government budget can change the whole sector by changing taxes, spending or incentive. For example, if government decides to spend more money on infrastructure, then companies like L&T can perform much well and there will be a gap up opening. If government decides to increase taxes on tobacco, then companies like ITC may suffer and open gap down. RBI's policy. RBI's decision on interest rate affects banks, borrowers or entire economy. For example, if RBI decreases interest rate, you will get loan at very less rate. Companies like banking, auto, real estate can gap up because the borrowing has become cheaper. On the other case, if interest rate increases, companies will gap down. War or geopolitical events. War, military conflicts or geopolitical tension can create uncertainty and move markets. Example, news of a major conflict overnight, global market fall, Indian indices like Sensex and Nifty can gap down. On the other hand, defense sector may gap up due to the expectation of defense spending. Fifth, election results influence expectations about government spending and economic reforms. For example, a stable majority government is elected, market become optimistic, Nifty and Sensex may gap up, open higher. If results are unexpected or uncertain, the markets may gap down. Sixth, global market. Indian markets are influenced by what happens in the US, Europe and Asian markets. For example, if US market falls 3% overnight, the next day Indian indices are going to gap down without any Indian news. Seventh, company specific news. Major announcement related to the company can cause sharp gaps. For example, company wins 10,000 crores government contract, there will be gap up. CEO resigns, gap down. Fraud allegations, gap down. Merger and acquisition announcement often gap up. Simple rule to remember: good news, gap up. Bad news, gap down. Types of gap. First, common gap. Common gap is caused by normal buying and selling activities. And this gap is filled within few days or maybe on the same day itself. For example, if a company closes 500 previous day and today it opens 505 rupees, there is a gap of 5 rupees. It can be closed today or within a few days. There is no major market news. It is just because of higher buying interest. A stable company like TCS or HDFC Bank may show small gaps after regular market movements. Second, breakaway gaps. Breakaway gaps occurs when a company is in consolidation phase. Sideways movement for many weeks, many months or maybe many years. This is the start of a next uptrend or downtrend. For example, a stock trades between 980 to 1000 rupees for several weeks. And now there is a announcement of profit. The profit is significantly higher. The next day the company opens 1100 rupees, far above the resistance level. This is a uptrend. A new trend begins. A stock breakaways when the company reports excellent results or receives a major government contract. Third, runaway gap or continuation gap. It occurs in the middle of a strong trend. For example, there was a positive trend, positive movement. Again, it has added to that positive movement. A stock which was trading at 500 rupees for several weeks, it has gone to 600 rupees. Now the next day, positive news comes and it opens at 625 rupees. Then again, it opens at 700 rupees. The strong trend is continuing. During a strong bull run, companies like Trend or HAL has shown strong buying momentum and continuous gaps. Fourth, exhaustion gap. This occurs at the end of a strong trend. There was a strong positive buying and it increased. Now the buyers and the sellers are exhausted and now this is a sign of a trend reversal. For example, a company which was trading at 800 rupees, it has in several months it has gone to 1300 rupees and now again the next day it has opened to 1360 rupees and the next day it opens 1200 rupees. This is a sign of a trend reversal. Many stocks during market bubble show exhaustion gaps before correcting sharply. Gap strategy for long-term investors. This is not trading. Rule 1. Invest only in fundamentally strong companies such as TCS, HDFC Bank, Infosys, Titan, Asian Paints. Rule 2. Wait for gap downs. Rule 3. Check whether the business remains strong. Rule 4. Invest gradually. Suppose the stock price was 2000 rupees and it has fallen to 1800 rupees. Don't fear, you just buy. Gap buying using SIP. Earlier you were doing SIP of 10,000 rupees. Now you follow a new rule. When there is a gap down of 5%, you invest 15,000 rupees. There is a gap down of 10%, you invest 20,000 rupees. Gap down of 20%, invest 25,000 rupees. This is how you lower the price. Mistakes that you will make. First, buying every gap. You will assume that every gap is a bargain. which is not true. A company might have fallen due to poor results, but maybe the future of the company doesn't look good. Ask yourself why this gap has happened. Second, ignoring fundamentals. You focus only on the price and not on the business. A company which was trading at 1000 rupees has become 500 rupees. You may think that it is 50% cheaper, it must be a great buy. The problem can be if the profit is falling, the debt is increasing, the management quality is poor, the stock may never recover. The best approach is check earnings, debt, cash flow, and the management quality before investing. Third, panic selling. You sell quality companies during market crashes. During the COVID crash, most of you sold quality companies like Asian Paint, Titan, HDFC Bank. Later, these companies recovered and reached to new heights. When the fundamental of a company remains strong, temporary fears can create opportunity. Fourth, using borrowed money, using loan or margin. You take a loan of 5 lakh rupees and then you invest in the stock market, and now the stock market falls 30%. You won't be able to pay the interest and you will have to sell the stock at worst possible time. Invest with money you can live invested for years. Fifth, averaging down bad companies. Just because the company is falling, you are buying it and averaging. 100 rupees you bought, it became 80 rupees, you again bought, it became 60 rupees, you again bought. You are averaging the company, you may be averaging a bad investment. You have not even checked the fundamental of a company. If that business is fundamentally weak, you are increasing your exposure to a bad investment. Many of you kept on averaging companies like Ace Bank, hoping that the company will recover and you will become multimillionaire, which never recovered. Average down only when the business remains strong and it is going down because of temporary issues. Golden rule: average down a good business, not a falling stock. Strong company with temporary problem is opportunity. Weak company with permanent problem is a trap. Risk management: never invest all your money in one gap. For example, there is one gap, you invest only 20% of the money. Another gap comes, first gap comes at 5%, you invest 20%. Second gap comes at 10%, you invest another 20%, 15%, another 20%, 20%, another 20%, last 25%, another 20%. This reduces the timing.